Good evening, everyone. I hope everyone is healthy today. And I think most of you
Professor.
already joined. Thank you for your attendance and I really appreciate it. So let us just get into our subject. And last time you have submitted your results. Unfortunately, I didn't have a time. Not the results, your expression of your opinions on the crisis that you have watched. And some of you already had a chance to watch this video before, but it's kind of was a revision and it was related to the risk management. So I will go proceed and we may discuss your results later, your explanation later. But now I want to move to the lecture that we are planning to start chapter one. And as I told you, all the chapters that we are starting, I will try my best to relate to the real market cases, some case studies. Now, today I prepared like 4 case studies. I will divide into 4 groups because we're 16 in here. I will divide into 4 groups. I will give you 4 case studies. I will give you 5 minutes to study those 4 case studies. You will present it, and then we'll return back and to make what do you call it, work on those case studies and try to relate what kind of risk management they could have been used to solve those issues. So starting with the chapter, let me share the screen with you. Okay. So as all fund managers know, actually they're aware of, not only the fund managers, all the bankers, all the financial managers, they have some information and they're aware of, even if a student in finance department, student in business department, in economics department, they know that there is a trade-off between risk and return. When money, when the capital have been invested in certain projects, you always face a trade-off, risk versus return. There's always a trade-off. And what we believe that, and what it has been known before, and what has been developed the theory that the greater the risk, the more return will be compensated. So the more risk you take, the more return you require if you put yourself into the shoes of the investor. This is what you believe in actually. So more money you put into account into a certain project, definitely you're taking a big risk. The more money have been put, the more risk you're in, the more risk you're being involved in actually. So that will make you to require more return, more profit, more rate of return on a certain project. So this is the theory that has been developed by financists and by Markowitz and Sharp. It was developed by Markowitz and then has been developed and proceeded by Sharp. So the term actually expect here when we say the return, when we say there is a trade-off between return and risk, we should really specify more clearly what do we mean by return. Is it actual return or expected return? Okay, before we proceed, can I get your opinion? What do you think when we say that there is a higher risk and it's written here, expected return, that why we should not say that it's actual return? Why we say that it's expected return and we believe that it is a trade-off between risk and not actual return but expected return. Why not actual return? Give me your opinion, please, on this issue. Any ideas? Because we make assumptions on historical data. Yeah, that's acceptable. And what else? What could be the logic behind this? Why not actual? Actual return, you already know it. You already get it. Then why there should be a risk on that if you know if you get it now for the actual return? So for the expected return, so the case in here, As our friend suggested.
Maybe, sorry,
Yes, please.
maybe expected return, it combines like all the risks such as, I don't know, inflation and etc. etc. Maybe something like that. Actual is like what you get, like the actual number, but the expected one could be like different within the facts of
You're very,
uh,
very close to the right answer. Just please get the right key word here. You're very close.
mm,
Look at the
no idea to be
terminology.
honest.
Look at the terminology, expected return.
Yeah.
What does it mean, expected return? The expected, like break the terminology into two parts. Expected, return. So expected is what? Something.
Yeah.
Something that is likely to happen, but not exactly.
Very good. Is likelihood. So here probability take the place. So we are not sure, but still there is a probability. There's a likelihood that this thing gonna happen, but it's not guaranteed. Very good. This thing that I was looking for it. So this is the makes the differentiation why there is a trade-off between risk and return, the expected return, not the actual return. The actual return is already occurred, but expected return is about to occur, but it may not occur itself. So this is the main issue in here. So in everyday language, the outcome that expected is considered to be like highly likely to occur. But in statistician languages, it has been defined that expected value of the variable as its average of the value or the mean value. So the statisticians, econometricians, they define this terminology as an average. So when we go to the formulation, you will understand why they have been used, like using some average and probabilities. So expected return, therefore, is weighted average of possible returns, where they weight applied to a particular return. So the weights are given. Let's say this return will happen approximately with a probability value of 20%. And this return will not happen with a probability return with 80%. And what is the weighted average return then? So we say that if you invest in this project, you will get 25% return. And the probability to get this is 60%. So you're like, most probably you will get this 25%. However, if the thing doesn't go well, if it doesn't go according to your plan, your return will be minus 20%. So you will not have a return, but you'll have a loss, which is 40%. But let me put in a weight term, which is 0.60 and 0.40. So this means that if this doesn't happen, it's about likelihood not to happen 40%. But if it happens, it will happen by 60%. Like there is a likelihood. So weighted average of your return should be getting the summation of it. This is what we call as a weighted average of it, according to the statisticians and econometrists. So this is how expected return is measured with the likelihood. So expected return is something that may happen, is likely to happen, but it didn't happen. And it may not happen, but it may happen. So you're trying to guess. You're doing the guessing here. Imagine that you have $100,000 to invest for 1 year, and suppose further that treasury bills yields 5%. So we'll move to example to the next slide that we get here. So the treasury yields 5%, and return for equity investment are here. So return will be 50%, 30%, 10%, loss of 10%, loss of 30%. But the weights of likelihood to happen this return, weight of probability to take the return place that has been measured in this way is 0.05, 0.25, 0.40, and 25, and 0.05. But in order to come with the weighted average return, we need to multiply weight with the return, expected return, weight with expected return, weight with expected return, and we need to sum it up in order to get expected return per year. So there is 0.05 probability that return will be 50%. There is a 0.25 probability that the return will be 30%. The 0.40 probability that the return will be 10%, and so on. And expressing these returns in decimal form, we need to convert into decimal form in order to come up with the return to calculation. So how we can do it? Just simple calculation, very simple calculation. Oops. Sorry, some. Now, first of all, 0.05 times 50%, okay, plus 0.25 probability times 30%, plus 0.40 plus, sorry, times 10%, not a plus, but a minus, because we during here loss, the probability that there will be loss is 0.25. 0.25 times 10% minus 0.05 times 30%. So return the loss. These are the loss, okay, guys? These are the loss. And this all, if you calculate, you're gonna come up with 10%. So this shows that the return for taking some risk by investing this $100,000 will be able to increase your expected return per annum from 5% offered by treasury bills to 10%. If the things work out well, your return per year will reach as high as 50%. But the worst scenario in here, the worst thing that could happen, the worst case outcome would get to the 30% of loss return. And if you want to measure in terms of money, you are welcome. So the best scenario is 50% of return, which is 100,000, or 50%, which 150,000 bucks. You're gonna get return if you're like investing $100,000. But in the worst scenario, if you're about to invest, you will lose 30%. Okay. So this is a weighted average of expected return is 10% we get from here. So one of the first attempts to understand the trade-off between risk and expected return that I already told you that was developed by Markowitz, and later by Sharpe it was carried out to improve it actually. And in 1976, there was another scholar who developed the arbitrage pricing theory that can be viewed as extension of CAPM model. I'm sure that you have heard this CAPM model. I'm going to go through this CAPM model again to review it. So maybe the first chapters will be a revision for you, but a more analytical part, like we will be looking from the analytical perspective, from the risk management. And to you, in order to, okay, we know that this is the expected return. We said there's a trade-off between risk and return. We know how to measure the expected return, but what are the ways to quantify the risk itself? I mean, how to measure the risk then? So how do you come up with this certain number that they're telling this is the risk that you're taking when you choose a certain investment? Actually, it is believed that the convenient measure is often used by scholars, finance people, by economists and statisticians, is a standard deviation, by how much a certain number is the mean is deviating from its average, the return over the year actually. So the standard deviation is the square root of expected return to the power 2 minus the expected return that you found it but we're raising all to the power 2. And this is square root of. This will give you a standard deviation. Sorry for my handwriting, but I'm trying to do it. So this is, we'll find it using expected return. So how we find it, in the previous example I showed you here, like this probability weight times by percentage, this times this time this. But in this case, what you will do, your return should be raised to the power 2. So we'll do here the following. So we'll do the same thing, like 0.05 times 50%, but to the power 2, plus 0.25 times 30% to the power 2, plus I'll put 3 dots plus so that I'll write the minus. I'll put the last number here. 0.05 times the worst scenario, 30% of loss to the power of 2. This minus sign I'm putting directly because this minus sign comes from here. It's minus 30. It means that it is in loss. There is a loss, okay? So there is a loss. I'm directly putting it. So this is, we call it, it's coming from here. This is what we search it. And whatever we find it in a previous case, like this multiplied this, this multiplied this, this multiplied this, and we summed it up, we got like 10% of weighted average of expected return. There's 10% of weighted average expected return. By calculation, let me put it here, 10%, we found it here. And we're gonna use it. Yes, this is what, like, then this 10% should be raised to the power 2. So whatever you get here, minus this 10% raised to the power 2, and you take the square root of it. This will give you a standard deviation. This will give you a standard deviation. So square root of 0.046, or we can say 4.6, or I can make it, if I put it in decimal numbers, so if it's 4.6% minus but it's better actually to use in decimal numbers, okay? So you're gonna use this one in decimal numbers. it's not to be getting into confusion. So 0.046 minus 0.10, so to the power 2. And this all should be getting into square root. Okay. As a result, the standard deviation is equal to 0.18.97. So this is standard deviation, how it's calculated. So convert this 50% into decimal. So by conversion, I mean make it 0.5, make it 0.30, but it's correct still we're gonna get it, but to get the more clear picture, not to be confused, so we can make it like this. So this is how they got it. So 10% is expected return that we found it, and standard deviation is 18.97%. So can we say that this investment is risky? This is a question I'm asking from you.
Yes,
Why?
because standard deviation is high.
Okay. Can I get your name, please? I just lost.
Eraj.
Eraj, okay. Eraj, what is the conclusion? Like, how did you come up with this, that saying that this, I'm sorry, that standard deviation of this investment is high? What made
I
you
think
come up with this
usually
decision?
standard deviation, which is not high, is approximately between 5 and 15%. Or am I wrong?
So first
Above
of all,
15% is high.
the first thing in here, where we are lack of information. What sort of investment we are doing now? Where we're investing our money? Okay, we know that there is a risk-free asset, but what are the other risky assets that we're investing money? So where we put this money into? First of all, what type of businesses these guys or project are being involved in? So how to measure this risk? Second, this standard deviation, in order to say, yes, you kind of saying right, but you have to be able to compare with the benchmark. There should be something to compare. If there is no benchmark, you cannot say, okay, imagine I'm alone in one field and there's no, I came to the competition and there is nobody in the competition. I'm alone who is competing. And automatically I say, I'm the winner, I'm the best. That would be really not good to say that this guy became best and he won the case because he was alone. But there was nobody to compare his knowledge. There was nobody that he could compete with, actually. So there should be something to compare. Like, right. Certainly it would be very rational to compare with its peers, with its competitors. Like if it's industry of IT, like Apple with Samsung, then you can compare. Apple got, let's say, 20% of standard deviation and Samsung got 25. Then you can easily say Samsung is more riskier. That means Samsung is expected to give you more return because it gives you more risky things. Same thing, we cannot say that the return is very high. You need the matter in here, it's a matter of the comparison. You need to be able to compare.
Right.
Okay. Anyway, let's move further. I'm sorry, I didn't off my telephone. I'm very sorry. Let me just off it. I forgot. Now it's okay. My bad. Okay, great. Now we were investing our money in one investment. And what if we combine our investments, make it two, like we choose to characterize every investment opportunity by expected return and standard deviation. So let's combine it. Like once we have decided and once we have identified the expected return and standard deviation of the return for individual investment, and it is natural to think that about what happens if we combine investment to form a kind of portfolio. Okay, why before combining any investment, any too risky investment, why we need to combine it? Why there is a certain need? Why there is a kind of need arised to combine different risky investments? Do I really need to combine? Why I shouldn't go just buy one investment and just get the expected return and share one risk of standard deviation?
In
Why
order to diversify your portfolio.
Very good. The idea is to get the benefits of diversification, to reduce your risk. So one thing that in order to diversify, like how it has been said that don't put all the eggs into one basket, just divide it, just split it into two baskets. If one basket fails, the other one will be kind of safe and that compensate those fallen baskets. So the idea is to diversify your risk. The idea is to diversify your portfolio. So considering just two investments with the return 1 and return 2, the return from proportion here is given. W is a proportion. Gamma is this representing the return of the first investment. This represents the return of the second portfolio. And this is the return from the portfolio itself. This is one investment. This is second investment. Like investment 1, which is risky as well. That gives you maybe cola. And so let's say you decided to combine two investments. Would you combine, if you put yourself into the investor's shoes, how would you diversify your investment portfolio? Would you invest your money in the same field, in the same industry, like Apple and Apple and Samsung? Or would you invest your money in different industries like Apple and Boeing, like airline industry and IT industry? What would be your decision?
Different industries.
If the same, why? If it's different, and why? Is there anyone who says, I would go for the same industry? Is there anyone who says that? Okay, I think nobody said, but what about different industries like IT and airline?
I would go for that. Like, make it from two different industries since, as an example, Apple and Samsung, they're competitors, right? And
Yes.
of course, they try to like be better than like each other. So it may affect the prices of stock or whatsoever of your investment. So if Apple would do something greater than Samsung, they're like their stock will get higher in cost and price, and the Samsung will go like down the price.
There is some word, there is one very good word, very like gold word that will describe your explanation. Your explanation is very good, and the thinking that you're thinking in that perspective that if they're highly competitors, or if they're really good competitors in a perfect competitive market like Samsung and Apple, if once companies' stock prices are going up, like appreciation in the stock price, the other one will go down. What could word describe this situation? I even
Correlation.
Correlation, very true. The condition of best combined investment in portfolio, the investment investment packages should have the minimum correlation At least they should be independent from each other. They shouldn't be correlated. If they're totally from different industry, which show they're not correlated, so it is the best combined, and this is best compiled portfolio. Having from the same industry, you putting yourself into the danger that if one stock goes up, the other one will go down definitely. So your job is not to lose. Your job is to win and win in both sides. So accepting too risky investment doesn't necessarily mean that you should sacrifice one investment and hoping to get something from another investment. So your hope, your aim, combining two different investments to earn from both sides. And you're trying to see the correlation should be very little, very minimum. If it's like more than 50%, it's strongly correlated, strongly positive or negatively correlated, that's really bad. That's really bad. This is not what we wanted actually. So in this graph, we can see that this is the standard deviation. This is the expected return. As standard deviation, as the standard deviation increases, the expected return increases as well. So this was the main idea of combining investments of risky to investment into taking into consideration that correlation should be very small. Okay. Before I proceed, let me just open Excel, give you an example. Just let's solve something. Let me get the formulation. So this is the formulation we are given. The return on the portfolio, this is weighted averages, and this is the standard deviation of portfolio itself, like the weighted average of the first investment, standard deviation of the first. This is how we calculate. And we are given some numbers in here as well. Gonna put it here. So if you're gonna calculate the first return, market portfolio return, expected return, portfolio, that would give you just weights are given here. So weights, let's say we invest to 0 to 1. Let's make it 0 to 1. If we invest 0 to 1 with the weight, okay. Let's make it like this. Kind of table, like I will go from the book. It's given in the book. And we have standard deviation of portfolio. Standard deviation of portfolio. And we have weights, like weights first investment and weights of the second investment. Now, if your weight is 0 in the first investment, that means 1 is in the second investment. That shows you like 100% invest your all money in the second investment. So what will be your expected return? What would be your expected return on portfolio if this is the weight distribution? Then weight distribution is this. We're just going to apply to the formula, okay? I'm going to tell you why I'm doing so. We're going to create different scenarios for this portfolio. So weight 1 is 0 times, oh, let me do it like this, times the formula is return on specific investment 1 is 10%, 0.10, or let's make it 10% directly to get absolute percentages here. plus weight of second times 15%. We get percentage here, 15%, okay? And this we get the return on portfolio, okay? We get return on portfolio. So 0 investment in first one and 100% investment in the second investment will give us 15%. Why? It's logical, because you don't invest anything and you get just 50% here. And standard deviation, it's the same thing here. You just apply the formulation. I'm using the Excel function because for easiness to calculate other scenarios, I'm just gonna drag it down. I'm gonna get the square root of it, okay? Square root, SQRT, open the bracket and just put everything here. So weight one is this, raising to the power 2 times standard deviation of the first, which is 16% here. 16%. Here's the question. Bekjan, yes, this lecture will be available. I'm recording it and I'm gonna upload it to the Moodle. So, and this Excel file, I will upload it as well into the Moodle. So you can follow the video and you can just access this things as well. So I will go slowly so that you can have access for the formulation as well. If I'm fast in explanation or slow, please let me know. So first I'm considering this part. Weight 1, which is 0, times standard deviation of 1, which is 16%, plus weight 2 here, raising to the power 2, plus, times the standard deviation of the second investment, which is 24%. And we're raising to the power 2. You know, let me just make it this with decimal. Let me work out this standard deviation, work out with the decimal numbers. 0.16 to the power 2 plus this to the power 2 times 0.24 to the power 2 plus 2 times correlation 0.2 times weight 1, weight 2, standard deviation 1, standard deviation 2. So weight 1, weight 2 times this times this times standard deviation of 1, which is 0.16 times 0.24. And we close the bracket. And I think that's all. And it should get the standard deviation for the portfolio. Yes. And I can make it 24%. So this is, we call it, if we weight distribution have in this way, like 0 for the weight 1 and 1 to the weight 2. But what if we distribution will follow in the following way, like 0.2, 0.4, 0.6, 0.8, and 1. 0.8, 0.6, 0.4, 0.2, and 0. So what will be the expected return on portfolio if the weight changes? So what we do, we just drag it down. I drag down. It's very easy to just drag. You spend the time on calculation the first row, and if you put everything correctly, then everything will be calculated automatically correctly, by taking correspondingly each weight here. So expected return is here, and standard deviation, we can just drag it as well. Let me just to see whether did I get correctly, but because decimal numbers, like this, that's better. Now, as an investor, your job is to choose a best investment scenario, like the best investment portfolio in terms of how much you're going to invest. So which scenario would you choose as investment? First, second, third, fifth, sixth. So we have 6 scenarios. In first scenario, you would invest nothing in the first investment. In second, you would invest just 20% of your money and 80% to the second investment. In third, 40 to 60. In the fourth, 60 to 40. In the fifth, 80 to 20. And in the sixth, 100 to 0. So you have to be very careful to select the best appropriate investment portfolio to yourself. You have to select, your job is to find a good investment to yourself and distribute your money in a way, to allocate your money in a way that will really benefit you. And the benefit you will get only if return is high and risk is low. This is what you're trying to do. So whatever you do, what type of business you are being involved in, so your job is to get as much as possible more money and as less as possible to get involved into the risk. So less risk, more money. More return, less risk. This is your job. So you have to find the scenario which is really fitting you, which is the best that will describe you. So tell me, what is the best scenario you can get it? The lowest standard deviation and higher return. Let me make it like this.
So maybe fourth and fifth,
Fourth and the fifth.
guess.
Actually, between the fourth and the fifth, the standard deviation there is much difference. There's very little difference, but return is 1% higher. So most probably you would go this,
Fourth?
the fourth scenario. Yes. If you're risk taker, if you're risk lover, and of course you will reduce your risk, the best is to get the lowest risk with the highest return is this one. Okay, let me save it.
Sorry, Professor, can I have ask a question?
Yes, sure.
Can we divide our expected return by our standard deviation so we can get the number of return we will get for each percent of our risk?
You're trying to calculate better. Wait, don't go so far. We'll come to that point.
Okay.
You're so far. I know you have taken some finance courses and you're already familiar how to find the betas. That's good. That's good. If you divide it, that will give you even more realistic picture. Let's do it. Let me just save it. I will just save it as risk versus return. Oops, I saved it in corporate finance, I think. My bad. Anyway, so let me see how much time we have got here. We've got 25 minutes. Okay. Now, I'll stop here. I mean, from the chapters, because I want to distribute something. Let me just share in the. I will break into rooms. Okay, into 4 rooms. We are 16 people here. I will break into 4 rooms. Breakout rooms into 4 automatically. Okay, and okay. Ademi, Aynur, Almat, and Ruslan. Here is the first group. Okay. Ademi, Aynur, Almat, and Ruslan is the first group. So what you will do, second group is Eraj, Adilet, Mehmet, and Julduz. And third group is Bekjan, Dongo, Dongoli, Sanjar, and Tengir. And the fourth group is Alua, Camila, and Shandibay Daulet. Okay. Now I will open the rooms. You will accept it, and you will just be divided. And you will get. So first group is Ademi. You will be the leader of your group. Ademi, can you hear me?
Yes, I can.
Okay. I will send you something. Now I will send you one article. You will all read this article together. Now spend just 5 minutes and discuss it. Then you will come up with a certain decision. What could be done to prevent certain situation? In just one sentence, okay? According to your opinion. Did you get what you're gonna do? I'm gonna give you one case. It's not a big case. You're gonna all read it, discuss it, and come up with a certain decision. What could have been done in order not to have this situation? Is that clear?
Okay.
Yes, it is clear.
Okay.
Yeah.
Ademi, you have the friends. Ademi, I know. Okay. Eraj, I will give you second article. So let me just send it to you. Okay. Okay. Let me just put it in the chat. Now, guys, I'm with you. It's Ademi, Aynur. Now I'm gonna send you. Wait just a second. I sent you. You should have received it. Bank of America. Okay. Do you see it?
Yes.
Yes.
Okay. Download it. Work on that. And you can share. I'm leaving the room. Hello, guys. Eraj, I'm sending you article now.
Yeah, okay.
Financial crisis 2008.
Mhm.
Okay.
Okay.
Wait, just let me open the chats. Okay, sent it. Did you receive it?
Yes.
Okay, get it. And you can discuss. I'm leaving the room. You can
Okay.
start discussing. You can just share the screen, work together.
Hello, Professor. Professor, could you tell us what's our task?
Check the chat. He's in the case in the group chat.
What chat, guys?
The
Turkish
group
Eğitim
chat.
Messenger.
Did you get it?
Could you say it again?
The group chat, Zoom group chat.
Oh,
It says HSBC money laundering case. Do you see it?
no, I don't see it.
I'll send it again.
So
See it now?
No.
Shit.
Wait. You mean this chat or
Yeah, the Zoom
the
one.
big? Okay, no, I don't see any.
Okay, send me emails in the Zoom group chat. I'll send you by email then, because I see it.
Okay. Can you see my email?
Yeah.
Okay.
Check.
hello guys.
Hello.
Okay, I'm sending to the chat the case of Lehman Brothers. Maybe you have heard it before. Just read it. Can you see it?
Yes.
Okay, just download it, read it, discuss with one certain decision what could have been done in order to prevent this case to happen. Okay?
Okay.
Okay, I'm leaving. And when you finish it, 5-7 minutes, when you finish it, come back to the Zoom. Just leave the breakout room.
Okay.
So in that year, in 2008, Bank of America agreed to pay 2.4 billion to settle a class action lawsuit with investors who owned or bought its shares when the bank purchased Merrill Lynch. So basically here in the times of crisis, Merrill Lynch, they were going down. They had no money and they were too big to fail. So which means that if they would fail, it would bring additional damage to the whole economy, not only of the US, but of the whole world. So that's why US government, they kind of forced the Bank of America to buy the Merrill Lynch. But the case is that in the negotiations between Bank of America and the government forced the CEO of Bank of America to keep silence about the future settlement, because if shareholders would know about the settlement that Bank of America is going to take, is going to buy Merrill Lynch, it would affect the stockholders and employees. So that's why they did it like in a secret way. So here the ethical problem rises. So some people think that they should have told the shareholders about the future settlement, but if they would tell, this settlement might not be happened. If it wouldn't happen, then millions of people would suffer. But if the CEO of Bank of America would tell it to their shareholders, they might harm other citizens of America. So in a nutshell, that's what happened in that case.
Okay. So do you agree on which side you are standing? Are you standing that they should have shared the information that they are going to acquire it, or they should have kept it silent?
I think they should have kept silent. Why? Because there was a greater good. They did it for the sake of the whole country. Because if Merrill Lynch would go bankrupt, not only the shareholders would suffer, but the whole economy would suffer because of that.
Very good.
That's why I think they should have kept silent.
Okay, thank you so much, Almat. Thank you so much. Okay, second group.
Hi everyone. So our case was about the financial crisis 2008, about the subprime mortgages and how people got defaulted on their mortgages, and there was a crisis in the banking sector. So the case that we had, it explained everything that was on the video, and also it shared a story which was a prerequisite to the crisis 2008, which was about the crisis before, which taken was in 2000, where there was a boom in the IT sector and people got many losses in that sector. So then people encouraged to invest in real estate, which led to the increasing prices of houses, which then further in 2008 encouraged people to take subprime mortgages. So that was a prerequisite to the crisis. And at the question that which measure that should have been taken to avoid this crisis, at the group we decided that the proper regulation on assessment of creditworthiness of consumer credit receivers should have taken, because the people, they were just so greedy, they wanted to earn, and they gave the loans to every people, whether their bad history of credit, so they gave to poor people, and therefore the probability of risk of default was very high, and therefore the crisis has happened. So this proper regulation on credit risk, on the risk of default, should have been taken to avoid this crisis.
Okay. Thank you so much. That's what you have said is really good, and that I would continue with you guys, especially with Araç again. Okay, I want to continue with you next class when we meet, because just only 1 minute left. So actually already nothing left. and we will continue. We'll get like 10 minutes more from the coming class, and we'll solve this issue again together. Okay, thank you so much. Eraj, keep in mind that I will ask you again,
Okay.
but some questions, not to explain again all the global financial crisis, but there is some specific question will be related to the risk management to discuss
Okay.
with you. Okay, thank you so much. See you on Wednesday.
Thank you. Bye.
Thank you. Goodbye.
Professor,
Professor.
bye-bye.
Bye.